Philippe Cloutier, President and CEO of Cartier Resources, a junior explorer developer here in the Abitibi Greenstone Belt, the Quebec portion. We're listed on the TSX-V with the ticker ECR.
Philippe, good to see you, sir. I know we've seen you on the platform, but I haven't seen you for a while. Good to see you, sir. Look, I just wanted to catch up with you because it's kind of an interesting period. Last 18 months have been very difficult for precious metals. Massive disconnect between price and equities at the moment there. And I couldn't help but notice you've been sort of quietly going about the business of managing your money, like lots of small raises here and there. Why do it like that?
Well, we've had lots of small advances, a different type of advances for the project. We are busy on delivering the PEA, busy having 2 machines working and drilling on the project to yet again increase the resource estimate. And we're also busy transitioning towards a new audience because the preliminary economic assessment has given us this entirely new ecosystem of the mining industry. And we felt we should be rushing into that, but we should transition slowly and manage not only our efforts, but the cash burn.
Okay, I want to come back to the cash burn, but sorry, it's something interesting there. You're saying that when a company kind of moves from exploration to discovery and then on to economic study phase, you think there's a kind of change in the retail or investor profile?
The audience. Yeah,
right.
The audience that sticks through with you through the prospecting, grassroots, leading up to the discovery phase, that's one audience. Then there's another audience that's in it when you start drilling up until your first resource estimate. And in our case, we've had the sponsorship of Agnico Eagle and ultimately with O3 Mining, we'll merge with their property. And as we were working towards a preliminary economic assessment, we felt, and we got those phone calls from a different group, institutional and corporates. And, it's all new to us and to them. So we're transitioning slowly towards that. And we're fielding and we're developing a narrative that fits our project, right? We have a past producing gold mine off the highway here in Val d'Or. So it comes with its benefits and its challenges. And since we're in a mining district, you have to be careful what you say because you're surrounded by some very high-end mining execs and engineers, right? So you can't just drop off a cost of building a mill. You have to be within the right numbers and the right parameters.
But tell me what you're doing here, because it comes back to that money, the money question, right? Which is lots of small raises. If I look at your press release over the last sort of 9 months or so, it's been mostly about a little raise here, a little raise there. And I get that you can advancing through to deliver that PA back in March. So obviously that quite nice NPV 5 of about just under 400 million, and just over 20% IRR. All good stuff. But what are the things that you think you need to deliver to talk to the new audience? The PA is a good start, but what precisely are they looking for? If you're looking in your regions, obviously a lot of big mining groups there, a lot of institutional eyes there. What do you feel that you needed to deliver to them over and above the PA? What specifically?
Well, a project that obviously is economically viable on its own, right? So if this thing flies while you're building a mill and you're integrating ore sorters, really high cost items, and you make a profit, then arguably it's going to be even bring more benefit if you don't build your mill with the ore sorters. You basically lop off about 150 million. But one of the reasons for the small raises is we're anticipating that in the PEA final report, you'll have a section called recommendations and opportunities and challenges for the project. And we just wanted to keep our powder dry until we saw what these specialists would recommend as work to be done to bring it to the pre-feasibility or feasibility. So we're taking baby steps and that money was essentially being used for the diamond drilling. Now, once we know which option or which alternative will ultimately favor the project or build more value, then we'll probably settle on the solution that will still build value while incurring the least amount of dilution for the project.
Right. See, it kind of interests me when I read the release with regards to the PEA. Okay, you make an interesting point about whether or not you do go and build the mine and bring on ore source. $150 million, which is not insignificant, on a capex of what, 340, right? Something like that, right? And obviously ASIC is below $800, so near 750. So you'd be making a lot of money, but and the payback under 3 years, all that kind of really good stuff. But is the consideration of DSO or tolling or whatever a reality for you? When do you actually go through the phase of understanding those economics, and how much money do you need to throw at that, and how long would that take to work out?
Yeah, that's a very good question, because so far we have, as you've noticed, we've paced ourselves very slowly from 0 resources to 5 years of continuous drilling, 4 resource estimates, consolidating to eliminate boundaries with our neighbor that can further expand the project east and west. We all know that in the Abitibi, your prime vector to grow resources at depth. So we're in a situation where we can keep advancing this project and grow the resource base. And the PEA we presented, I think people can understand that it will not be a project expansion. We won't go from 4,500 tons of mining per year to 8,000 tons or 10,000 tons, but we'll be most likely going through an extension phase where we extend the mine life of the project. If you expand the project, you dramatically raise the capex. You have to resize the shaft and things like that. If you extend the project's mine life, then you're still producing an appreciable amount of gold ounces per year. We're talking at 117,000 ounces per year with $1,000 US per ounce. So that's $117 million of free cash flow for a minimum 10 years. The reason our all-in sustaining cost is so low is because we have a shaft and a lot of underground development that already exists. And the initial, I think 60% of the ounces will be mined in and around the old workings. And that's one of the reasons we have a good control of our costs going into this. But it's all about the extension east and west and at depth that will unlock additional value for this project. And it's really not all that complex, but to constantly re-rate, rank, and prioritize your targets in and around the shaft. Do we go for those shallow targets? Do we go for the extension deep targets? These are the things that are constantly being re-rated and re-ranked, and it requires that we go at this and pace ourselves intelligently instead of throwing 10 drills at it. I think that's the difficulty that's lost on our audience right now, but is appreciated by the institutional and the corporates.
No, I get it, but I think most people forget you've got 3 million ounces already, and if you're with the and it's PEA plus or minus 30%, but if you go through the phases relatively quickly with even what you've got today, and that's a kind of desktop exercise primarily in terms of the cost, etc. But it's a big project. 117,000 ounces is not to be sniffed at. Anything over 100, all good news. But my point is, if you were sort of having these conversations, I know you've just off the back of a big road show through Europe as well. You're getting the feedback. You're getting to understand what people are looking for. That's why I asked you. What is it that you need to present? Put best foot forward and all of that. And therefore, do you know where you've got to allocate the capital? Is it a case of, right, with PEA done, PFS next? We understand the recovery rates and the metallurgy. Let's get on to the next economic study. Is it as simple as that?
No, it's not as simple as that, because our share count is although is pretty high by now, 330 million shares outstanding. although 30 to 40% of that is held by corporates and institution. We've got a nice protective moat. We're at a critical point where people are looking at, what are you going to do next? Are you going to dilute the share count to get it to the next phase and build it yourself? Or are you going to dilute the project by surrendering it, a portion of it, in exchange for that cash that come in to bridge you to the feasibility, pre-feasibility phase? Right now, we're not only are we transitioning towards a new audience, but we're transitioning to new expectations, which we're trying to math out. So it's challenging, it's fun, but I can appreciate that in a sideways market such as now, where there seems to be, as you mentioned, a disconnect between the price of gold and junior explorers, developers, and miners, their share price. I could appreciate that right now people are just on the sidelines waiting to see what we're going to do next. And that's the benefit of having toured Europe and part of the States, is I got some feedback and I'm bringing that to the board and the team, and we're working through that in the next month or so.
Right. Okay. And with regards to, clearly, like I said, it's a difficult market for all precious metal companies, big and small. So I'm not going to mark you down for, share price or market cap or any of that sort of stuff right now. But it's an expensive thing. It's a dilutory thing to do these raises. So really, what I want to understand for you is, it's about the efficiency of the way that you spend the money. It's about the value that you create with the money that you raise and then spend, and where you allocate it. So you're saying you've got a sense of what the things are that you need to do. It's a discussion with the board. Can you shed some light on what that could look like for the rest of this year?
Well, just before I answer that question, I'd like to point out that all of the raises were small. You have a company such as Agnico Eagle, who has a $40 billion market cap, that in this instance bothered saying, Phil, we like what you're doing. We like your team is highly efficient in moving this forward and de-risking it. And although it's a small check, it's a big message, and we're going to continue sponsoring your efforts. That was very recent. Now, in order to continue attracting that sort of constructive criticism and compliment from other corporates such as Agnico, we need to choose right. And we are waiting for the final report, which will, as I mentioned, include that recommendations chapter, which we intend to take very seriously because they will measure the pros and cons on various scenarios. Keep in mind, the preliminary economic assessment is not a detailed analysis of the optimal mining plan for a certain project. It is a preliminary economic assessment. In this case, they said, we're going to build a mill, ore sorters, this is the mine plan. And they could have said, we're not building a mill, we're sending it down the highway to any number of numerous mills, right? And so we're waiting for that chapter. We're going to sit down and brainstorm it. And I think we want to work on the next phases that will offer us the greatest amount of optionality to move this thing forward, and bring in the right partners to help us do that. Because it's a nice situation to be in. We have a project that is standalone, economically viable. We have a project that continues to grow, and we're still drilling it. We know the resource is going to be upgraded, and therefore the PA is going to be upgraded. And the only bad thing about it is it lands right in the middle of a market that doesn't seem to appreciate the value that we've created for this project. I mean, we've drilled it continuously for 5 years, about $15 million invested. We're tracking in at $8.50 per ounce increase on this project. It's really efficient, high performance.
Okay. I hear you. $8.50, that's a nice number. Let me take you back, though, like just over a year ago, right? You did that deal with O3 Mining for the East Cadillac property. I don't think you got any value for that then. What was it about that project, with that asset, that you thought could add value to your story? If not then, when?
Well, it was clear, having done the internal engineering studies on our smallish Chimo mine project, it was very clear that this mineralization continued east and west, and at depth it would plunge onto their ground. That's the first thing. And then further along strike, maybe 10 kilometers to the east, there's another deposit called Nordo East. And then additionally, those corporates that had been in our data room said, Phil, we feel this thing's going to fly, and those property boundaries are limiting your upside. Get rid of those. So one, we completed the consolidation. It was ignored by the market, got no value. The other thing that didn't get any attention was the fact that once we had completed it, Agnico sent a clear message once again and increased its participation in Cartier. And from that point on, we initiated the diamond program that's on its way. We've delivered the PEA reports is next few weeks. So 2022 was, you're right, everything that we accomplished in 2022 went largely ignored. Stepped into 2023 and delivered drill results in PEA. Apparently it's still being ignored, but we are addressing the story to a brand new audience, and we believe that this new audience will take us to another phase or another level for the project. And I trust that when you build value for something, the market can only ignore it for such a time. And then at one point it says, holy shit, these guys have built this value. And then they come in.
Okay, well, let's talk about what you think you've got compared to other $40 million Canadian dollar companies at the moment. What are those things that people need to understand and need to value in a way that they're probably not doing right now? Okay, so you obviously PEA is a good start. Amount of ounces is a good start, but what's so special about you guys?
The jurisdiction where we're set up. I mean, we're in an area, you can look at the PA numbers themselves. And when PA numbers are published in remote areas, you've got a lot of wiggle room. You could say about anything that there's no local operation that are going to challenge the cost of your mill builds or your mining and milling costs. When you're in Val-d'Or and right down the highway, you've got half a dozen producers, you're more constrained with the numbers that you actually produce. I would dare say that this PEA is closer to a PFS than a PEA, because it will be peer-reviewed by the local producers. And knowing that, you can't afford to lose that credibility, because then the value of your document, the value of your work is just thrown out the window. So that's the first thing. And I believe that in the next steps that we work on here at Cartier for Chimo will trigger that re-rating, that reevaluation of the project. That's all I could say. That's what we're working on.